Seeing that we are now in the beginning of the new financial year, all of our contribution limits to our retirement products are being reset to 0. This means that for our tax-free savings account, we can allocate a fresh 36,000 Rand between the 1st of March 2022 and the 28th of February 2023. Now, this got me wondering, is it better to immediately put in a lump sum of 36,000 Rand at the beginning of March, or should you rather divide it by 12 and follow the phased-in approach, aka Rand cost averaging, where you basically invest 3,000 Rand per month over the next 12 months? Which one would statistically give you the best possible returns over the long run? So if this is something that you've also wondered about, then sit back, relax, and watch this video all the way to the end. You may be really surprised to see what the actual answer is. Now, as you all know, I am a numbers guy, so I think this is a good place to start. The one thing that I believe we can all agree upon is that when it comes to long-term investing, the markets do always trend to go up. This may not always happen in the short term, as we are currently experiencing, but despite numerous setbacks like a global pandemic and war, the magnetic pull of human innovation, efficiency, and determination will always drive markets to go up over the long run. Let's look at this chart, which shows the performance of the S&P 500 over the past 40 years. As you can see, the markets move up a lot more than what it moves down. So, based on this argument, putting your entire lump sum in the market means that you are statistically far more likely to be catching an upward trend than a downward one. So from this perspective, it makes sense to put a lump sum of your money into the markets as soon as possible, rather than by phasing it in over time. Okay, ja, maar Peter, how can I base such an important decision just on some pretty picture? Okay, fair enough. Let's look at some real numbers. Vanguard, which is one of the most respected investment companies in the world, published a study in 2012 that compared investing a lump sum to phasing the investment in over a year for 3 different markets: the US, Australia, and the UK. They then evaluated the performance of each strategy under different types of asset allocations across almost 100 years. They summarized the results in another pretty picture just for you guys. As you can see, the results are pretty conclusive. Around 2/3 of the time, you would have achieved a much better outcome by investing everything at the beginning instead of phasing it in over time. And the average magnitude of outperformance is around 2%. So again, statistically, you are better off following the lump sum approach. Case closed. Thanks for watching, guys. Bye. No, life is not just as simple as that, is it? Even though the odds are in your favor, there's still a pretty decent chance of 33% that you'll be worse off by investing a lump sum. And if this set lump sum were to be a very large amount in comparison with the rest of your investment portfolio, and you invest it all at the wrong time, you could actually be way worse off. For example, if you decided to invest into a New York Stock Exchange index tracker right before the start of the global financial crisis of 2008, it would have taken you until November 2013 to recover your initial investment. That is 6 years wasted just to break even again. If this was money that you intended to use for retirement or a child's education, then you would be in serious financial trouble. Attempting to time the market works in an extremely small number of cases, and most of these can be attributed to just pure luck. If you instead follow the dollar or rand cost averaging approach, you may be underperforming a lump sum strategy statistically by 2%, but this approach does at least offer some protection should the markets go haywire. Also, during a bear market, such as what is seen during a market correction or crash, a rand cost averaging approach will deliver far superior returns because you would have bought each month at a better price as the markets fell, and therefore you would have gotten more units for your rands. And seeing that personal finance is, well, personal, it often is not just about the numbers. So let's look at 4 other important human aspects that we also need to take into consideration. Seeing the markets crash just after you have nuked a huge amount of your hard-earned money into it can cause severe anxiety to many people. If you cannot tolerate the constant daily movements of the market, and if a daily drop of 30% of your investment portfolio will give you constant headaches and sleepless nights, then for your own sanity, follow the phasing in approach. If you attached a lot of emotion to your money, say for instance you received a lump sum as an inheritance from a close family member that passed away, you could be left with a lot of regret and a feeling of irresponsibility and guilt if you see your investment losing a lot of money right after you have invested it. This could potentially cause a lot of tension, especially if it was an inheritance that you shared with a sibling or a spouse, as they may blame you for the loss. And although it would not necessarily have been your fault and that the loss will only be on paper, this is probably stress that you would rather want to avoid. By following a rand cost averaging approach, you are investing consistently every single month. And if you are investing consistently, this means you are also saving consistently, as investing regularly creates a great savings habit, which is one of the most important cornerstones of financial freedom. And then lastly, say you did put in a lump sum just before the market crash in 2008, would you have remained invested until 2013? Or if you were investing on a monthly basis, would you have continued making regular investments while watching the markets rapidly decline? Kind of similar to what happened in 2020 and what is currently happening. An investor's ability to stay calm and keep their emotions in check is a very important criterion for successful long-term investing. It is never lacquer to see your investment portfolio continuously going down, and this does make it difficult to remain invested regardless of what strategy you follow because of our brittle human emotions. So in general, if you want the maximum possible returns based on statistical probability, then a lump sum approach would work best. But if you want to minimize your risk of losing a lot of money soon after a market crash, leaving you with a bunch of regrets, and you are happy to trade higher potential returns for ease of mind, then a rand cost averaging approach will be more suitable for you. Okay, so it is good and all to know the arguments for both sides when it comes to general investing, but how exactly does this apply to a tax-free savings account? Well, a tax-free savings account is unique because we are all limited to an annual contribution of 36,000 Rand and a lifetime contribution of 500,000 Rand. On top of this, all of your investments will grow free of interest, dividend, and capital gains tax. So this kind of makes many of these previous arguments to be void. In the grand scheme of things, a lump sum of 36,000 Rand is only about 7% of your total contribution limit. So if you were to invest just before a market crash, this would not be as bad, as you would still have at least another 13 years of the same contribution to try and make up for it. So it won't technically cripple you financially as it would have been if it was, for example, 50% of your portfolio. Also, the most important thing about a tax-free savings account is the tax-free savings part. The more you save on taxes, the better. And the longer you save on taxes, the more these tax savings will compound over time. And as some random Moshanyana with a bad head day once said, compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. So by investing a lump sum at the beginning of the tax year, you will essentially give your investments an extra 12 months to grow completely tax-free. For example, if we assume inflation is 6%, you are in the 30% marginal tax bracket, your portfolio return consists of 15% interest, 25% dividends, and 60% capital growth, and you receive a return on your investments of 10% per year, a lump sum of 36,000 Rand on the 1st of March can grow by 3,600 Rand over the entire year, and of this 3,600 Rand, tax on interest, dividends, and capital gains would amount to around 600 Rand. So by rather allowing this lump sum to grow inside the tax-free savings account from day one, you will get to keep and grow this 600 Rand, which will have a massive compounding impact over a long investment horizon. And considering the fact that you will be making contributions to a tax-free savings account for at least 14 years and that you should intend that money to grow and not withdraw any from it for a couple of decades, putting lump sums in every single year is essentially also a phasing in approach if we zoom out and view the investment over a couple of decades. And even though the markets may crash, which they most certainly will, it is okay, because with a tax-free savings account, we have plenty of time on our hands. And then the last point that I want to make is if you invest through an insurance company, they may charge you a fee for every single debit order. So if you have 12 debit orders going off every single year, that is 12 times the cost of just investing a lump sum once a year. And just as the autopit taught us earlier, compounding can also work against you, and paying extra fees will erode away your returns every single year. So this is also something to keep in mind. So to summarize, investing a lump sum will, on average, achieve a better outcome, but it is riskier, especially if you don't have any more money to add, or if the lump sum is large enough to dwarf your existing investments and future contributions. The phasing in approach, aka Rand cost averaging, will on average perform worse, but it carries way less risk and will give you a much better ease of mind. But considering the special circumstances of a tax-free savings account specifically, in that any given lump sum won't really make up too much of your total portfolio, that you'll earn higher returns from the compounding effect of taxes being saved, and that you intend to keep your investment running for many decades, I can confidently say that if you have the financial means, then it makes much more sense to just invest a lump sum into your tax-free savings account as soon as we enter a new financial year. But that's just my opinion. What do you think? Let me know down in the comments. It is always lucky for me to hear you guys' opinion. Regardless of which strategy you end up following, both of them are still very good options and way better than just doing nothing, as you are getting your money into the market, and with a long-term view, this can only mean a good thing. Now, if you are not sure where to open a tax-free savings account or what exactly to put inside one, then make sure to go check out this video. Thanks for watching, guys. Have a lucky day. Cheers.